You are holding in your hand 100,000 VND.
That sounds like a lot.
One sufficient amount. So you can feel safe when you look at your account. But let's stop for a moment. How much will be left 5 years from now? Maybe you'll still see it in your savings account, a constant number that lies there like an old friend. But when you take it to the supermarket that ever bought a whole cart, I can only buy half now. It's not because you're wasted, but because the value of money is quietly receding day by day. Like a bucket that's punctured and the bottom is leaking that you didn't notice. Our worries. Sometimes it's not about losing money, it's about keeping it. But there's no buying power. And that's even more dangerous. Because it makes you think you're safe, while reality is slipping slowly. But a lot of young people, especially between the ages of 18 and 40, is still repeating a financial cycle quite familiar. Send a bank when you hear low interest rates, buy gold, and then leave it waiting. Wait for the price to rise, wait for the opportunity. Waiting for something more certain. And while waiting for the years to pass, the opportunity money lies still and value quietly evaporates. Some people believe that gold is an absolute shelter. Someone else thinks, just let the bank. More than lose a few more audacity than all in real estate, stock or crypto without a clear plan. In fact, no channel is immune to risk. Gold has been around for 5 years. The bank is not enough to cover inflation. The stock market can go up and down dramatically. Real estate is like a god. But sometimes the whole thing freezes. What you need is not a magic investment. It's a financial strategy strong enough to survive every cycle, whether it's crisis, inflation, or bursting bubbles. And that's why you're here. In this video, I'm not just sharing with you a simple recipe. It's a smart capital sharing map, with 4 layers of financial protection from secure defense, growth to investing in yourself. You're not just going to hear the theory, but also see real-world examples. From a young person in Vietnam, open a small coffee shop with 30% capital, to a calm Japanese investor, breakthrough after the crisis. I believe that you don't have to be a financial expert, but you can be the boss. Your own cash flow, starting from today. First, we've come to the concept of what idle money is. If you're holding a sum of money without any problems, not living expenses, it's not borrowed money. It's not money for sudden illness. Congratulations. You are holding in your hand one of the most powerful tools in personal finance. Idle money. But unfortunately, most people do. I don't really understand its nature. A lot of people think, just have money, excess out after spending is brought to invest. And so they rushed right into the gold, crypto securities, or contribute capital to open a shop with friends. I don't know what kind of money I'm using, how much risk it can take, and how much I can lose it and still live well. Idle money is not money of chance. It's not money either free to gamble with the market. Money is the rest. After you have taken care of all your obligations, pay bills for essential expenses, and especially after you've set up a contingency for emergency situations such as 7 jobs, serious illness, accident, or personal crisis. It's capital waiting for an opportunity, but it means to stay in one place. I hope the bank will take care of everything. In a period where inflation can exceed 5% per year, and the bank only returns 4 to 5%, let the money sleep. It's no different than letting it fall behind every day. The biggest problem that many people face, it's the mistake of idle money and venture capital money. Investment money is money you are willing to risk, even lose white without affecting life. But idle money is different. It needs to be protected between safety and controlled growth. If you can't distinguish between these two currencies, it's easy to fall into the wrong investment trap. And then it will be the cause, pulling you into a personal financial crisis. A friend once shared that he has 50 million extra raw, and immediately buy a stock, according to the leak. Here's from colleagues. After 3 months, the stock dropped nearly 40%. I had to cut my losses because I needed money to pay for my father's hospital. The problem is not the stock, it's that he used the wrong kind of money. That money should be in the safe. Or redundant. It's not about getting into a risky place as high as the stock market. In fact, most Vietnamese today, there's still no thinking about how to classify money. They only know if they have money. If you have free money, send it to the bank. Or listen to that ASA buy gold then buy Theo. They've never been taught that money has a personality. It also plays a role in the personal finance system. And if you've got the wrong role, the risk will multiply. In this era of upheaval, the concept of idleness is no longer the same as before. Once upon a time, money in the bank could survive. Interest rates are volatile today. Price escalation and any shock from the world. From war, disease to the banking crisis, it can have a direct impact on your pocket. Today's idle money doesn't just need to be safe, but it also needs to be flexible and profitable. It can't lie still, it can't be impulsive. It needs to be treated like a logistics soldier. Not on the battlefield. Always be ready to fight. If the personal finance front has turned, it's important to ask yourself, it's not where to invest. It's what kind of money I'm holding. If you can lose it 100% and remain calm, that's investment money. But if you only lose 20%, you've lost sleep. It's idle money, and it needs a different strategy. There is no universal formula for everyone. The best starting points is to learn how to classify the money that you have. Sit down and list each item. Ask questions for every dollar. Where did it come from? For what to do? And loss of influence Russell. Only by understanding the role of each cash flow, you are strong enough to move on to the next part, like dividing capital. Generate cash flow and asset growth in a sustainable manner. If you've ever confused idle money and venture capital money, don't blame yourself. It's the beginning that most of us go through. The important thing is from today, you start to become more conscious. Because $1 in the right place isn't just extra money. It's going to be the foundation for a future of financial freedom. And no longer worry when the upheaval comes. I'm going to show you inflation history in a minute. He was one of the robbers, the most quiet and terrifying property you'll ever meet. Money that doesn't stand still is money that holds the price. Money is still in the wallet, in the safe, or even in a bank account. Without a protection strategy, is quietly devaluing little by little every year. That's inflation. One of the most underestimated financial risks. But it's quietly eroding the wealth of millions of people. Let's look at the real lessons from history. Not to be afraid, but to wake up. Inflation is not an academic concept. It's an underground wave. Has swept away the wealth of the millions of people all over the world in silence. 2008 Vietnam. Facing one of the most difficult times after renovation. Inflation soared above 20%. A purchase for $100,000 at the beginning of the year. By the end of the year it could rise to $120,000 to $130,000. People hold money in their hands and feel it. It's like holding sand flowing through your fingers. The money is still there, but it's less visible. And the most painful thing is interest rate. The bank can't keep up with the rate of devaluation. Vietnam is not the only case. That same year Zimbabwe became a global obsession. Demand for hyperinflation. Inflation rate up to 79,600,000,000%. Almost 80 billion%. A loaf of bread could cost Zimbabwe billions. And people who go to the supermarket have to carry sacks of money. Don't think a lot of money is expensive. It's time to pay. The bread went up by 20%. It's a joke that financial people often tell. In Zimbabwe, if you want cheap lunch, let's order fast. If you're 10 minutes late, you'll pay double. A little further into the past, Germany 1900 to BA the Weimar period. It's the strongest evidence for the fierceness of superpower. Inflation. After World War I, the German government printed money massively to pay off the war debt. The mark has lost value. People need a cash wheelbarrow to buy a loaf of bread. The value of the currency plummeted rapidly. That civil servants are paid to buy 1 days. Let them buy before the price goes up. Imagine you get paid in the morning. And in the afternoon, that's enough to buy half a kilo of potatoes. Germans at the time were used to go into the market in the middle of just to race at the speed of rising prices. More recently, to years number 19, Argentina has a large economy in South America saw the peso lose more than 80% of its value in just 1 year. People work all year, but wages aren't enough to buy basic food. People who run out of cash become the biggest victim again, even if it's not wasted. What's common in all these stories? No one can predict exactly when inflation will break out. It doesn't come like a thunderstorm. It's like a little dust rain, uniform and persistent. You don't get wet right away, but after a year, you'll get wet. When you realize purchasing power has worn out to the point of no return. In hyperinflationary episodes, the best survivor is not the rich. It's people who transfer assets to channels they hold value like gold, hard currency, or real assets with cash flow. Who hold all their assets in local currency, keep it in the closet or in a savings account. They are usually the ones who lose the most. Because they believe that the money that's in the books is enough. It's actually 5 to 7% inflation per year. You've lost almost 40% of your purchasing power after 15. It's when you lose and you think you're safe. Inflation doesn't have to be super high to be dangerous. It just needs you to be defenseless. So should we take all the gold or change it all to dollars? The solution is not extreme action. It's in consciousness that cash has longevity. And you need a strategy to keep buying power. Inflation doesn't rob you of wealth overnight, but it's going to do that in a few years, if you don't notice. Closing inflation is not fiction. It doesn't just happen in some distant country. It used to happen here in Vietnam. And if you don't act, you'll probably look back 15 years later and realize, I worked hard just to keep some money. Not as much meaning as before. Next, let's go to the multi-asset view. In the modern financial world, I is also about category diversification. But when I ask the truth, most young people in Vietnam still around with be it familiar names. Save money to buy gold. And if you have a little bit more, think about real estate. So actually these 3 old acquaintances have kids strong enough to withstand with a market that's moving endlessly. And the answer is, unfortunately, no. Let's think of a portfolio as a dining table. If you only have 3 eggs, white rice and water, no matter how safe, that meal is also malnourished. Your body needs more vitamin protein. The property too. We need more to grow sustainably. In addition to bank, gold, and real estate, the modern investment world has countless other asset classes that many young people in Vietnam have never heard of, or heard it but never cared deeply enough to understand. And so, their personal financial portfolio is easily out of balance. The first is government bonds, one of the safest properties that any country can release. You don't have to be as rich as Warren Buffett. It was purchased in Vietnam for only a few $1 million. You could have bought bonds through a bank or securities company. Not high yield but almost absolute stability. This is hot soup on the table. Gentle but necessary to keep balance. Next is the ETF. This is one of the easiest ways to own a large basket of stocks without studying each code. Instead of having to choose to buy FPT/VCB coupons, VNM, you just need to buy at VN30 or ETF S&P. Your no-no is to stick with the top companies. It's like going to the supermarket and buying a basket of very fresh, diverse, and convenient. Another good option is to read Real Estate Investment Fund. If you don't have enough money to buy an apartment or land, we can start with a few million to own a small portion of an investment fund into the mall, hotel, or office building. Advantage is that you're still benefiting from the real estate market without borrowing. Don't worry about paperwork. They are not afraid of neighbors building next door. Then the goods. An old property class, but often overlooked by the Vietnamese. Except for gold. World of commodities including oil and gas, wheat, coffee, and in times of crisis. This is a group that can raise prices because it's tied to real needs. You can invest through the International Commodity Fund or buy shares of mining companies. Processing. And it's impossible not to mention the cryptocurrency class, the most controversial property. It's also the place that's created the most billionaires in 10 years. Of course. This is hot spicy on the table, not for the weak. But if you know how to limit risk, good understanding of technology and reasonable allocation, this could be the spice. Help the portfolio grow dramatically. The important thing is not to let crypto take up all the disc. I think it's a small part of the whole thing. What's the problem is that most young Vietnamese, I'm eating a meal with some old food. They're not wrong, but they're missing a rich investment menu, waiting to be discovered. There are many reasons, partly because they weren't taught, partly for fear of risk, in part because it's safe to deposit. But safety means efficiency, and it certainly doesn't help you break through. You don't have to hold all the assets at once, but you should know they exist. You should understand the strengths, weaknesses of each type. They know how to combine them. Like a good chef. Eat less spicy food. If you add something, add it regularly. If you are fat, choose the right time. Multi-asset management is not just for the rich. It's a mindset that you don't put all your financial future into a single channel. And in a world as volatile as it is today, this mindset is one of our most valuable assets that you can equip yourself with. I'm going to share with you the golden rule to manage the property. In personal finance management, the question of where to invest is always asked the most. But the really more interesting question is how to split the money to be both safe and profitable. This is the stopper, deciding you survive the crisis or swept by the market. There's no capital sharing formula absolutely right for everyone. But there are smart models that are easy to understand. It's especially suitable for young people. In an era of economic uncertainty, here are 3 models that are considered spine for money sharing thinking, effective, from traditional safety to modern innovation. Each model has its own strengths, and most importantly, you have to know where you are, what you need, and how much you risk. 1. Model 30-43-10 Classic Balance. This is the classic model, often mentioned in basic personal finance programs. 30% defense for gold and hard currency. 40% safe bank transfer. Government bonds stable quarter certificate. 30% stock growth. Small business cash flow generating model. The concept of this model is based on philosophy. There is a protective part stable and part to hit out of the border. That's higher than average. Take controlled risks. This is the right model for people. There's an emergency fund. Have a moderate to decent income. I want to sleep well and dream big. Strengths of the Model 3 for 1030 is that you're not betting all your hands on a channel. If business 7 fails, there is still 70% to do it again. If the market moves strongly, you still have some gold or bank to keep yourself from panicking. But the downside is that it's a bit of a middle ground, not too aggressive or too defensive. With the adventurous, or in a period of rapid accumulation, this model can be seen as a bit of a gentrification. A to Model 53-10-20 for safety priority. This is a version with a thicker back cushion. 50% structure is absolutely safe. Cash bank accounts with high liquidity. 30% gold USD defense. Assets hold value when inflated. 20% controlled growth. This model is born for beginners to invest. People who have fallen and want to recover. People with family responsibilities need stability. The obvious strength is a high level of psychological safety. When the market goes down, you're not broken. When you need to spend money quickly, you don't have to cut your losses. 80% of categories. Be ready to defend against any changes. Disadvantage of maintaining this model for too long. Property will grow very slowly. If you're 25 to 35 years old and you want to accelerate, 20% growth may be too little to do. Especially in the age of digital finance, where opportunities and risks rise quickly. This model requires the user. You have to get rich slowly to get rich. BA. Wheel model for layers. Capital sharing thinking, the proactive type. This is an improved model, the most modern and in-depth BA. Choice. Structure. 25% defense gold physical USD outpatient assets. 25% bank safety. Bonds fund bonds flexible account. 25% growth. Blue chip stock small business model. Selective capital contribution to 5% human capital feeding new learning. Skills health language course. Psychology. The special feature here is the fourth layer. Invest in yourself. This is the part that most young people forget to share. They put the money for learning skills in the consumption or surcharge. They don't consider it property. Actually, a 3 million course on digital marketing, if applied effectively, can bring in an income of 10 million per month. A good English class can help you double your income in a few years. And a regular exercise routine is an asset. Help you save hundreds of millions of dollars later. For layer wheel models suitable for people. There was long-term thinking. Want to speed up but don't bet. Believe that you yourself are the most profitable investment asset. It helps you not only increase money, but also increase capacity. Not just property, but also have the skills to maintain and develop that property. A young person who applied this model once shared, "I spend $1 million a month learning from finance to marketing. At first it was just knowledge. 6 months later I got my first freelance job. 2 years later, I'm making twice as much as my old job." Student section. That's faster than my stock investment. Of course, this model requires more discipline, because the part that's invested in itself is easily delayed. I am too busy this month to study next month. But if you can commit, this is a model that helps you grow sustainably and the most comprehensive. No matter which model you choose, the most important point is still, don't leave money in one place. And don't put it all in one place. Just as the body needs enough nutrients to be healthy, personal finance, it also takes multiple asset classes to be stable. These 3 models are not for you to choose once and apply forever. Depending on the stage of life, acceptable level of risk and personal goals, you can completely adjust. The important thing is that you have a system. There's a map that's proactive. Instead of passively letting money flow by interest rates, I'm going to share some examples of what they've done. Different ways of dividing money. And you'll see who wins and who loses. The first story about a man born in 1995. Graduated from University of Information Technology. I have been working full-time in it since I was 23 years old. After 4 years he accumulated capital of 200 million won. The amount is not too large. It's the fruit of hard work and disciplined spending. The army is careful. They don't like risks. When asking friends, I also recommend sending it to the bank. Maybe some gold to keep the price. So you split 80% into the bank for 12 months. The remaining 20% buy gold bars. I check back every year. The account has added a few $1,000,000 in interest. Gold goes up and down, but not significantly. And so I'm assured that I'm doing the right thing. Until one day, a close friend who works in the industry. Even though you're funding a tech startup. Good idea, clear product. Strong team and need about 100 million initial investment. The army hesitated. I've heard a lot of bad investment stories. You should decide to refuse. 3 years later the startup successfully raised a Series E round. Your friend's stake is up 15 times. There are 200 million in the book, plus some 10 million in interest. But now I understand. Money is not lost. But the opportunity passed and didn't come back. Ngok's story is different. Born in 1990, used to be an English teacher. I quit my job to sell online. They are quick to get to the top after just 2 years. You've amassed 150 million in interest. The first amount of self-help you get. Ngok loves real estate. I hear the land is constantly rising. An acquaintance invited to invest in a fertilizer
lot
project
in the coastal area.
Clear legal commitment, prices only rise not fall. With the trust of someone new to the game, I took the entire $150 million to deposit. But not long after that, I think the project is not legal enough. Transaction is suspended. The land cannot be sold, and there is no cash flow. For the next 3 years, you have to earn every penny to survive. And Kia's money lies in a meadow that grows. You didn't lose everything, but the money was tied up. You've lost your flexibility. Maybe you need it to keep growing. Work in the business. The school is another example. Born 1988. Once every 7 failures to open a coffee shop with you. So when we get back to 300 million contribution from office and freelance work. So he decided to split the capital on a 4-wheel model. 75 million for defense. He bought gold and kept more dollars in a foreign currency account. 75 million safe. Short-term bank deposits. And part of the bond fund certificate purchase. 75 million growth capital contribution to reopen small coffee shop. But this time it's self-contained and cost-controlled. And the remaining 75 million invested in themselves. Learn more marketing, financial management for business people, improve health. After 5 years, the school cafe became stable. For cash flow is about 12 million per month. Gold and USD rose slightly. Bank account, always enough to manage in any situation. But the most special thing is, it's the courses you pursue. It helped me understand how to manage my money better. From HR books to advertising strategies. Total assets do not spike. But there's real cash flow, and most importantly, the school feels secure because I'm in control of all my personal finances. No more walking in the dark like before. And in Japan, a country that's traditionally frugal, there was also a small investor who did a miracle. After the financial crisis of the early 90s, over 90, when the Japanese stock market crashed and real estate plummeting, most people returned to safe property, bank deposits and gold. But a middle-aged engineer decided to do the opposite. He divided the property. 50% held in gold, defense, and Japanese government bonds. 50% invest in small technology companies. But the potential. At that time, very few people believed that technology will rise the Japanese economy. In the next 15, shares of software companies, 6 circuit, and robot production growth 10 times. Not just keep the property. He became $1 million. Dare to go against the crowd, but still conscious enough to keep the defense secure. What is common to all of the above examples? It's not that whoever has more money wins. It's not that AI is better than words. It's somebody who knows how to divide capital strategically. That person retains control. And then there's the opportunity to go further. In personal finance, the 7 biggest losses are not losing money. I don't know. What am I doing with the money I keep? Because when you don't have control over your capital, sooner or later you will make others rich. Accidentally. And now, I'll help you take control. Financial psychology and emotional traps. Financial market. It's not just a numbers game. It's a giant stage where human emotions take over. From greed to fear. From hope to 7. And especially the endless comparisons. We're not robots. When you see the price of gold rising continuously, it doesn't fluctuate. When the stock is on fire for 3 consecutive sessions, that doesn't feel a bit throbbing in the heart. But it's those feelings. If not managed, it becomes a trap. And it's not a trap out there. It's a trap in my head. One of the most common pitfalls is FOMO. Fear of missing out. It's called the fear of missing out syndrome. You hear that Bitcoin just passed $60,000. You see friends showing off a profit of a few $100 million. You surf TikTok. People say time without coming in, losing the chance of life. And so you jump in. Don't need to understand much. Just can't stand the feeling of being left behind. Greed in a rising market is instinctive, but real financial acumen, it's about stopping at the right time. The later you get in, the more likely it is that you'll be the one swinging. And then after a few adjustments, you realize you're not an investor. It's the person who pays the tuition to the person who came first. The opposite of FOMO is panic selling because of fear. When the market is on fire, account drops 10%, then 20%, then 30%. The news is all negative. Group chat broke out calls to flee brothers. You look at your account and it hurts. Even if you've said long-term investment, but now the long-term seems a bit of a luxury. This feeling is more dangerous than greed, because it doesn't just make you lose. That makes you whole at the bottom. The crowd psychology. It makes us feel like it's right to act in large numbers, despite the fact that financial history has proven who goes against the crowd at the right time, the long-term winner. Another very silent psychological trap, but it's common to compare with others. You invest regularly, buy some blue-chip stocks every month. Regular interest rate 8 to 10% per year. But then you see your best friend showing off his trade, 50% profit in just 1 week. You start to feel like you're playing a little bit better. You want to take more risks. You force capital that's safely flowing into the growth zone. When the market adjusts, you're cowering and selling your losses. The cycle just repeats. Comparison is a human instinct, but financial comparison is a pointless race because everyone's starting point is different. Different goals. Acceptable risks are also different. What you see is the surface. What you don't see is the discipline of luck. And sometimes there's depth behind the gear. The perspective of behavioral finance. Pointed out very clearly. Human, not making rational financial decisions like a textbook. They're dominated by prejudice, reference group emotions, and short-term psychology. And only when you realize this, you start investing with the system, and not just by feeling. For example, a classic study has shown that, after people see their friends make big profits from stocks, they invest in stocks even if they don't understand, increased by more than 70% if they see that a near them has just lost money. No matter how good the chances are, they're still reticent. Your investment decisions don't just come from the price list. It comes from the drinking table, group chat, and social media. What does that mean? What does that mean? You need to build a strong financial immune system. Be awake enough. Know when the market is good. And when mass psychology is pushing you too far. Be calm enough to know. It's not when the market goes up. Ghost is when you keep the plan. Remain disciplined despite the raw sell market. An old investor once said, "When AI is excited, I'm more careful. When the AI panicked, I started looking for opportunities." Maybe you don't have to invest like an expert, but you can totally think as someone who's in control of his emotions. The financial market doesn't have a lot of money. It will eliminate people. I can't control greed and the fear. So before you learn how to read charts, read financial statements, learn how to read yourself, so as not to get caught in these emergency
waiting
traps
for you
at every step. Next, I'll point out the mistakes that we'll often encounter. One of the most dangerous things in personal finance, it's not about losing money. You think you're doing the right thing, but it's actually slowly coming to a dead end. Silently without sound. The common mistakes. This is the most important aspect of how young people handle their finances. It's not a tall thing. They're so simple that AI has had them. I just didn't realize it. The first mistake. It's also common to believe in a single channel. Some people believe that bank deposits are perfectly safe, and that's the whole property. It's in a savings account. Term 12 months. Some gold lovers see gold as a financial talisman. You should collect all the money to buy physical gold and store it under the pillow. There are also people who have full faith in real estate. See real estate as an investment destination. So, we're going to drain the capital and pour it all into a piece of marginal land. I hope it will double in a few years. The story is, every investment channel has its strengths and blind spots. Banks are safe, but yields are lower than inflation. Gold holds good value in times of crisis, but often sideways during periods of stability. Real estate has long-term potential, but poor liquidity, and in particular, the legal risk is not small. A healthy financial portfolio needs to be diverse. Like a decent meal, there's a knife with protein and starch. You can't just eat one thing forever. Put all your faith into a single channel. It's like getting on a boat alone without life buoys. The waves are fine, but the wind rises. One hole is enough to sink. The second mistake is not having a backup fund. It sounds simple, but a lot of people, especially young people, ignore it. They think I'm young enough to do it. Whatever happens, we'll figure it out later. But a personal crisis doesn't precede an accident. Once lost a job or a family event, enough to make you sell your property. When the market is at the bottom. And you didn't just lose money. It also loses initiative. A car running out of gas in the middle of the road. No matter how strong the engine, you have to push. Your savings account doesn't help you, but help you not have to sell off when everyone is panicking. And that's in the long run. It's what keeps you alive through cycles, up and down of life. The third mistake is the lack of a regular check-in plan. It's like financial health. They also need to be checked regularly. But most of us just plan once and then let it go. No tracking. No adjustment, no rebalancing of the portfolio. You're supposed to hold 30% of the gold, 40% of the banks, 30% investment. But then the market got hot. The investment is automatically 50%. You're excited about interest, but didn't realize that the risk was also increasing proportionally. And then when the market corrects, you lose more than you expected simply because you're no longer keeping the original structure. Imagine that you have planted a garden. You have to prune the branches, watering, pest inspection periodically. Personal finance as well. Every 6 months, or at least once a year. Sit back with yourself. Reopen the asset allocation table. Compare the adjustment rate as needed. It's not a labor-intensive job. It's how you show that you're really alive. Responsible for the future. The last but not least common mistake is listening to hot advice from friends without understanding the nature. Gold is going to buy fast. He just got 40% profit from X stock. Buy it. Long in real estate is hot now is not late. That kind of advice sounds fascinating. It's often accompanied by strong emotions and trust from loved ones. But the question is, do you really understand that channel? People can profit 40%. But when did they get in? Did they escape at the right time? They use 7. No, they're talking about the tip of the iceberg. Investment is not a contest run according to rumors. It's a long journey to understand, not to. You can learn from others, but the decision has to come from you, based on real knowledge. It's not a temporary euphoria. Personal finance, it's not about how much you know. It's how many fundamental mistakes you avoid. So, if you realize you are making one of the above mistakes, don't blame yourself. The important thing is not to be wrong. It's whether you're wrong again or not. I'll share one with you next. An extremely simple action checklist, but it's enough to change the whole personal finance mindset, if you take it seriously. Personal finance management doesn't require you to be good at math. It does not require an MBA. But it needs one thing. You have to be serious about your money. And seriously can't remember the mouth. You need a specific action checklist. Like a map for free travel. Money is not for reading, but to really follow. The first thing is to set personal financial goals. It sounds like a soft skills class, but in fact, it's the foundation of all decisions. Money later. What is short term? Maybe buy a new laptop, travel, or pay off your credit card debt. Medium term, maybe it's buying a car for a hostel to accumulate business capital. Long term, early retirement. Buy a house for college. Or simply not having to worry about money when you're 60. When there is no clear goal, you are easy. Spend money on things you don't really want just because it's selling. But when the goal is clear as day, every dollar has a direction. It's like a financial GPS. You don't get lost anywhere because you always know where you're going. Next, let's make a capital split table using different formulas. 3 for 103.5, 103 to 10. For layer wheels. You don't have to choose right away. Try to make an Excel table or write by hand. Divide the amount you have according to each formula. Each recipe will lead to a different strategy. Secure flexible growth or invest in yourself. Let's say you have 100 million. According to the traditional model, you spend 30 million, 40 million in the bank, 30 million for small business. But if you find yourself in need of psychological stability, maybe you're leaning 5310 to 510 million in the bank. 30 million is gold and foreign currency, 20 million for investment testing. That kind of tabulation helps you see the consequences, the potential of each option, instead of dividing it up. When you see the risk, you're more careful. When you see the opportunity, you're more confident. After dividing, don't forget an important thing that very few people do. Write the worst-case scenario for each channel. If gold drops 20%, do you have SOW? If the property is legally suspended for 3 years, can you rotate the capital? If the stock you choose drops in half, you're awake enough not to sell. Fear often comes from surprise. But if you're mentally prepared, you won't be surprised. And so don't get carried away by the crowd. Write the worst-case scenarios down on paper. Not to threaten me, it's about training yourself to stay calm when the market doesn't agree. Finally, set a fixed schedule every 6 months to have a personal finance meeting with yourself. It could be a Saturday afternoon. You make a cup of coffee, open the computer, and look back at the entire distribution table. Which one's growing? Which one's getting too big? Which one should be cut? Finance is like a long-distance car. You can't keep the steering wheel in a fixed direction forever. Every route, every weather condition, every unexpected pothole on the road requires you to adjust slightly, but in time. That's why. Because of the periodic rebalancing, it's a mandatory factor if you want your personal finances to be healthy and not deviate from the original goal. Small note: personal finance meetings don't have to be expensive. No need to make a slide. No need professional control panel. If you take your time seriously, I can't surf TikTok and watch movies. Think of it as the most important meeting, because you're meeting with your own future. Financial checklist. It doesn't make you rich overnight, but it helps you know where you are. Where are you going? And what adjustments are needed so that they don't fall off the tracks. Everyone will have their own journey. The checklist is the map. You paint your own path. Clearly proactive and reliable. Next, we will go into the section that a lot of people care about, but it's also the easiest part to make a mistake. Capital for growth. This is not the place to try your luck. It's where you need strategy, knowledge, and the sanity to make it a real motivation. Help you break through financially. Many people think growth capital, it's like a lottery ticket. If you try one hit, change your life. But the truth is, this is not a place for luck. If you use it like that, it's easy to lose weight. On the contrary, if you think of this as a nursery where we sow carefully selected seeds, then after a few years it's this part that's going to generate cash flow, experience, and confidence for you. It's like a garden. You can't grow any seed. You need to know what your soil is, what season to plant, and how to care for real germination. Let's go through 3 specific examples to understand how to use the growth part properly. A small business, many opportunities, but not easy to eat. A young man once shared that, I used 50 million from the growth to open a coffee shop. Takeaway small. It's right around the corner near the university. Things didn't go well at first. Less menu guests, have not optimized Facebook ads. Running forever is ineffective. Has a monthly loss of nearly 5 million. But instead of giving up, she adjusts. Cut the menu down to 5 hot-selling items. Cooperate with delivery app. And switch to the morning and noon time. After 3 months, the restaurant started to be profitable, BA to 5 million per month. By the 6th month, it is refunded. This story shows small business is not a straight line. If you understand the market, do it optimally continuously. It's a very reliable growth channel. However, the risk lies in the effort. You can't spend money and wait for it to come back. A business is a slow-paying job. It requires you to enter the dreamlike reality. Blue chip stocks are slow but steady. Most people are new to investing in stocks. They usually hit their head in stocks. Code rumors, hot rise code coming, game code is having waves. But the results are already known. The next wave is swept away. The game has not yet burned the account. Some people choose blue chip stocks. That is, big companies have brand, stable profits and dividend payments. Don't expect to multiply by 10 after a year. But it's a place that keeps good money and it's profitable. You can start with familiar names belonging to or as FPT, BNMVCB purchased every month as long-term. After 3 to 5 years you'll see the difference. It's not just the account balance, it's about peace of mind. The biggest plus is that you don't have to monitor the electrical panel every day. We don't have to gamble with the news. Slow but sure. And with the growth part, it's always going to be faster. Buy needs to understand the need for black and white paper. This is a high potential channel, but it's also a place where it's easy to lose money and losing sleep. For example, if you have an acquaintance, you can raise 100 million to open a bakery. The idea is attractive. Cake craft raw material clean takeaway model. But if you don't understand the model, I don't know the operating cost, there is no clear commitment, then this capital contribution is the same as an indefinite loan. If you want to be successful, you need 3 things. First, understand the industry. You don't have to be an expert, but at least understand the cash flow, profit, operating costs. Second, choose the right person. Not because of the body. It's because he has the ability to operate. Financial discipline. The third has a clear contract. Write down how much I contributed on paper. Who is responsible for what? How to split interest, when to pay back. Don't be afraid of losing your contract to protect both parties. Not because we don't trust each other. If you contribute correctly, you can benefit as a shareholder. Profits are not operating. If contributed wrong, you'll find yourself contributing emotionally to conflict. So the growth part is the incubator, not the casino. It's where you sow well-founded ideas. Do them with understanding, regular monitoring and adjustment. Once the tree is big, you can harvest it for a long time. But if you just sow it and don't water it, without testing, only grass grows. Let's finally imagine a scenario that a lot of financial experts have warned about: an economic crisis in period 2025 to 2030. Not to panic, but to prepare. And the sooner you prepare, the better. Crisis is not a strange thing. World economic history, every 7 to 15 years, there's a big adjustment. And it rarely announces by text message. Inflation can spike. The real estate market could freeze. Stock fall, no break. Crypto from virtual can evaporate for real. And the only thing that hasn't changed is unprepared AIs will panic. Those who have a plan will act. There's a classic saying in the investment world: the crisis doesn't kill you. Lack of liquidity is the end. What does that mean? Is when the market crashes, you don't die because the stock drops. You die because you have to sell it at the bottom to get money. Because you have nothing else to hold on to. In contrast to the person who has divided the capital reasonably before, have saved property. There's a little gold. There's an investment that's generating cash flow. It's not just surviving. It's buying things at a discount when people are scared. Imagine that the stock market drops 40%. People who are not prepared are panic selling off the app. And who has the spare part of growth available, smiling for a chance to collect. Or real estate stagnates, prices plummet. The margin borrower will sell at a loss. 30% gold and 40% safe haven. Then choose freely. At that time, cash was king. But only for those who have prepared. This is the reason why the rich, they get richer after a crisis. It's not because they're lucky. It's because they buy the property cheaply when others dare not keep. Warren Buffett once said, "Be greedy when others are afraid, fear when others are greedy." Sounds simple, but to make it happen, you need a solution before the crisis happens. So what exactly do you need to prepare? First, let's assume that every investment channel, it could all fluctuate in the next few years. Even things you think are inevitable, like gold or real estate. No one knows for sure that the price of gold will rise forever. No one can guarantee. The land market will not freeze. Financial markets are where anything can happen. Preparation here means diversification. Do not put eggs in a basket and always leave the back way. Second, make sure you have a secure asset class, bank cash, government bonds, or high liquidity fund certificate. This is the part that doesn't need a lot of words, but it should be easy to use when needed. When the market goes bad, it's a cushion that keeps you from breaking your back. When the market recovers, it's a launch pad for you to buy at a good point. Third, if you have a risky investment like crypto, small shares contribute business capital. Let's always assume that part of it. It can lose 50% of its value in a year. It's not pessimistic, but so that you don't collapse psychologically if that happens. When you are mentally prepared, you don't act in a panic. And finally, understand that crisis is not a disaster. If you are prepared, it can be a scary time for someone else. But it's the season. Good price property hunting of the patient. Visionaries don't just survive a crisis, but also break out from there. This is the right time to look back at your personal financial structure. If you find yourself putting too much money on one channel, consider splitting it up again. If you don't have a defense, let's start accumulating this month. If you're all in a game, ask yourself, if things reverse in the next 6 months, do I stand still? Because in finance as in life, the calm person in the storm is always the one with the magnetic field, not the one who runs to buy even when it's raining. We've talked a lot about gold, real estate bank, about inflation, and very real mistakes that I can also have. But if you only remember one thing, remember this: money should not stand still. Because money stands still, it doesn't mean you're safe. Sometimes it's just that you're sleeping in a false peace. Until you realize that the purchasing power has evaporated, the opportunity has passed, and you're not motivated enough to start over. History has proven many times, people who don't share capital are the easiest to lose. And losing here doesn't have to be overnight. It's fading away over time. Lost the opportunity to take initiative. Loss of flexibility in all financial decisions. You've seen the 3 capital division formulas from the 30 model. 43-10 traditional to type 53-10-20 for the prudent. And especially 4-layer wheels, where it's not just growth safety defenses. But there's also the most important part that many people forget: invest in yourself. Because sometimes the capital is worth the most. It's not in the bank account. It's about ability, your health, and thinking. A person who constantly upgrades himself, I'll never run out of opportunities because they're the most reliable revenue channel in the long term. So financial freedom, it doesn't come from how much you earn, it's how much you keep. And more importantly, is your money working for you or not? Maybe you're holding 50 million in your hand, 100 million or more. But what's important is not the numbers, it's that you have a strategy for it to multiply, to exist, and protect you in any situation. Don't wait for the crisis to divide. Don't wait for the opportunity to collect money. What you do right now is how to shape your finances 55 years later. And if you're serious about this journey, leave a comment below. Let's exchange more. If there's 100 million idle today, which recipe would you choose? 30 for 10-30 or 53-10-20 or 4-layer wheels? I want to know your choice, because every one of your posts is an inspiration for the others.